Welcome back to Trade Talks. We are broadcasting live at Inside ETFs at Hollywood, Florida. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. And joining me at booth 207 is Sean Clark. He's the CIO of Clark Capital Management. It's nice to see you outside of Philadelphia.
Hey, good to see you.
Especially this time of year, right?
Weather, sunny outside. It's great.
All right, let's talk about top-down, bottom-up investing. What are those styles and how can they be blended?
Awesome question. So, as an investment management firm, we're an active shop. We believe that active managers should be able to do a couple things. One is outperform the markets over time, and secondly is reduce risk. And the way we do that is through being top down and bottom up. So bottom up, really it's what everybody thinks of how they invest. It's looking at a company, ripping apart its financial statements, income statement, balance sheet, statement of cash flows, and really making the determination if we want to own the equity, so the common stock, the debt, both or none. So that's one strand of DNA that runs through what we do as an investment management firm. Secondly is top down. Top down is looking at the world from a different perspective, not at the individual company level, but from a top down global macro perspective. So taking into consideration trends. We use what we call a disciplined, objective, quantitative, relative strength discipline that really looks at trends and take two securities, take one and compare it to the other over time, and you can objectively get a picture of which is outperforming. And we want to allocate to those asset classes, ETFs, stocks, et cetera, that are outperforming and away from those that are underperforming.
Let's look at the CCMG top-down fixed income strategy. Right now, you can't get enough fixed income. It's all everybody wants to talk about.
Yeah, so within fixed income, we run a strategy called fixed income total return. What we're doing is we've identified three distinct sectors within fixed income that we want to tactically and opportunistically allocate to over time. High yield debt, so below investment grade fixed income, high quality fixed income, which to us is US Treasuries, and third is T-bills. So we run this top down relative strength process to objectively identify where we want to allocate to. So the strategy right now is allocated to high yield debt. It's been allocated to high yield debt for over 22 months. It's been a fantastic run. Credit spreads peaked at about 840 basis points in 2016 in February. They're down in the low 300s. So there's a lot of the run has been had. But for us, we're running this relative strength methodology. As long as that trend remains intact, we will continue to allocate to high yield. So right now, we still favor credit over duration with the economic environment as it is, right? So.
Right. I was just going to ask you, does your economic outlook impact this strategy?
Absolutely. So if you think about it, high yield debt below investment grade credit is levered to the U.S. economy. When the U.S. economy does better, typically that asset class within fixed income does well. And when it doesn't, when the economy's in stress or recession contraction, the risk off asset classes, U.S. Treasuries or T-bills typically do well. So our thesis for this year is we're still going to get through this year without an economic recession. Everything we look at from an economic standpoint, leading indicators, consumer confidence, the yield curve, the health of the labor market tells us we're going to have continued economic growth. We've expanded. Actually, the pace of economic growth has accelerated over the past 2 to 3 quarters. As long as that continues and persists, we expect the high yield trade to continue to do well and outperform both U.S. Treasuries and T-bills.
All right. Well, thank you very much for that insight.
All right,
traders, thank you for joining me today. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.